I suggest you need to send an email. The things will be cleared by tomorrow morning. Yes, I will coordinate them. Don't worry. Oh, I'm already live. Good morning, everyone. Hussain Qazi here. Ladies and gentlemen, before starting the session, I wanted to take just 2 minutes to share a short real life case with you. Yesterday, I visited a coffee shop with my friend. I placed an order for coffee, only for coffee. And while waiting, I noticed the weather was very pleasant, like today. I also decided to have a slice of cake as well. So I walked over to the showcase filled with a variety of cake. As a human being, one cake immediately caught my eye, but it looked messy and unattractive, like the pictures, like this picture. Ladies and gentlemen, you have to observe whatever I am sharing on the PowerPoint presentation. That's very much important. So, the cake looked very messy, unattractive. Honestly, I felt disappointed. And that disappointment reflects with my face expression. My facial expression showed it. What I didn't realize was that the restaurant manager was also observing me. He was also observing me. I decided not to order any cake. Here I decided not to order any cake and return to my seat and start communication with my friend. A few moments later, before receiving my coffee, the server came to my table and served me that very same cake, the second one. Surprised, I said to him, I didn't order this. And believe me, he smiled and very softly replied, sir, it's a compliment from us. The moment I heard compliment, my mind reacted differently. My earlier negative impression about the poorly presented cake disappeared. In fact, ladies and gentlemen, with the fork placed neatly on the side, it suddenly felt special. It's special for me, no? It's special for me. I know that you must be wondering, Mr. Hussain Qazi, why are you telling us your tragic love story with the piece of cake with us? Because presentation matters. Presentation matters. The same cake, the same ingredients, but the way it was presented changed everything. Ladies and gentlemen, a very warm welcome to my IFRS 18 presentation and disclosure and financial statement lesson. Now I'm going to start my lesson. Do remember, presentation matters. You and me are professional accountants. Professional accountants. What our responsibility? Just to make financial statement like in a manner to throw all transactions and make a statement and just throw to the investor, the user of the financial statement. No. Well presentable financial statement, because investor will use that financial statement to assess the performance of the company and to make a final decisions about their investments. IFRS 18 is actually a bridge between the preparers, the preparers of the financial statement, and the investors. IFRS 18 wanted to ensure that The financial statement must be made and present in a manner with full of clarity, consistency, and the user can compare the financial statement with different with different companies, compare with other companies, which means something standard. Standard means they are same, the bases are same. By the way, what we study in terms of accounting standard, international accounting standard, international financial reporting standard. So word standard, it's very important. Standardization, that's reflect consistency. That's reflect if user use our statements, he the investor must be confident that okay, something is standard. It's the base are common for all. We can compare. The investor can compare with others as well. So presentation matters. Based on this, IFRS 18 it's going to publish, but before starting in details, we have to develop some backgrounds. Huh? I'm not going to start the lesson exactly what inside the IFRS 18, but we need to develop the mindset. Mindset includes some important points. First of all, the key facts. The very first, students here. What's the scope? With IFRS 18, we will not discuss anything about recognition and measurement. The IFRS 18 is all about presentation and disclosure. That's all about. Number two, the most historical accounting standard, that's IS1. That's IS1. Now IFRS 18 is going to replace the most historical accounting standard. With my 20 years career, I observed multiple changes with IS1. But first time I'm observing that IS1, the most historical accounting standard, is going to dilute, no more, and replaced by IFRS 18. So you can feel that point, how much presentation it's now become important. IFRS 18 name starts with presentation. IS1 is also the presentation, but now the things is going to completely change. That's the point. Objective. The IFRS 18, who plays the role as a bridge between maker of the financial statement and the user, the investor. What's the objective of IFRS 18? We, the professional accountant, must have to prepare the financial statement which shows transparency, clarity, transparent, where the investor can trust. Where the investor can trust. The effective date, whatever the annual accounts start, whenever the annual accounts start from 1st January to, if the annual, it applies to annual periods from 1st January 2027. Early adoption is allowed. Early adoption. So these are the key facts. Still, I'm not going to start the facts of the details of the IFRS 18, but before that, first of all, if we make and present the financial statement, we have to aware that the financial statement having 5 components and supported by the notes. 5 components are statement of financial position, statement of P&L, statement of other comprehensive income, statement of changes in equity, statement of cash flow. And these are the primarily financial statement. And if the user wants more detail, so we make the notes as well. But the question is that where the things is going to change. Very important. IFRS 18 affects the complete set of financial statement. Left side, the change divided into 3 parts. Major change, minor change, minimal change. Major change belongs to statement of P&L and the relevant notes. Major change. Minor change to the statement of cash flow. And very minimal change Rest of the components, statement of financial position, statement of OCI, statement of changes in equity. So our core focus about the discussion is about statement of P&L and relevant notes. Yes, we will also cover the cash flow as well, but the rest of the components remain same. Sir, do let us know what changes has happened with IFRS 18. Wait another 10 to 15 minutes. Before that, we are going to start in detail about IFRS 18. Two things need to consider. Number one, as I said earlier, we as a professional accountant make the financial statement for investor, but how the investor use that particular financial statement, why it's relevant for the for the for the investor. It's important for us because whatever we are making, if it's useful for the relevant person here, the investor, that means our work become worthful. It's having value proposition. So we need to know that what investor will expect from our financial statement. There are two things very clear. You need to observe the picture of this lady. She is standing in front of the stock index of the company. If that lady, for example, a potential shareholder where she wanted to buy any company shares and refer the financial statement prepared by us, so she expects that based on financial statement, based on the P&L component of the financial statement, based on P&L component of financial statement, whatever we have shared with her, the P&L, she wanted to assess the future cash flows. So our report, our P&L, she will consider as a basis. Based on that P&L, she needs to assess the future cash flows. The investor assess the future cash flows based on financial statement. Plus, assume that that lady is actual shareholder of the company. Actual shareholder. She wanted to know the performance of the management. So if the actual shareholder, our report will be used as a performance measurement, like the P&L as a performance measurement. If the potential shareholder, they wanted to assess they wanted to use our P&L to assess the future cash flows. The first important thing. So if something is going to change about presentation, which means that IFRS 18, it's more emphasized, or ISB wanted to more emphasize about the investor expectations. Means they wanted to emphasize to make the financial statement considering these points. Obviously, something with IS1, there was some gap. Something with IS1 having some limitations, having some problems that's need to overcome with the new accounting standard. So before moving towards the IFRS 18, we have to know that what's the problem with IS1? What's the problem with the IS1? The problems of IS1 with viewpoint that whatever the IS1 suggested, that's not exactly meet the investor expectation. That's why there is a need of another accounting standard that's called IFRS 18. That's called IFRS 18. Now we need to discuss, I'm going to discuss this point, the problem of IS1 with the real practical case. These are the two factual statement of P&L. Assume that we are investor. We are investor, assume, not the maker of the financial statement. Assume that. By the way, this slide is about two real facts. Toyota real annual accounts picture, Toyota Pakistan. that by name Indus Motors Limited, 2023 accounts. Honda 2023 accounts. Atlas Honda in Pakistan. Assume that you and me are the potential investor of any of one company, and we are comparing two companies. Another, some things very clearly need to understand. First of all, we are an investor, number one. Number two, it's not compulsory that we are accounting literate. Maybe we are engineers. We don't know exactly about what the technicalities of the accounting. We are doctors, but we have money, we have amount, and we are searching that why not to invest in the automobile in the Pakistan. And today's morning, we are comparing two accounts. And we know that these accounts are audited, for example, by big four firms like PwC. And we heard that these accounts are prepared based on some accounting standards, but we are not aware about the accounting standard. We don't know the technicalities of the accounting standard. Huh? But as a layman, any of the human being, if have the money in the pocket, wanted to invest in the company, what the first thing they will notice, the investor will notice? Obviously, sir, profit. This the highlighted point, the profit. Compare the profit, two profits. Toyota 2023 profit 9.6 billion. Honda profit 5 billion. The first one is profit. I'm not saying that you have to invest based on only profit, but the first important thing is the profit. Okay. But first thing, you have observed the profit. And after that, for the next point is that what are the basis of these profit? No? Means all revenue minus cost are the basis. So you trust on the audited accounts. You and me trust on the audited accounts. No? And we already observed that these two income statement are some standard base. Standard. Huh? International accounting standard. International accounting standard. So we have the mindset that whatever the P&L have made, that's something standard. But we noticed some key points here. Notice. What are the key points? Number one, listen carefully. Toyota mentioned a subtotal called net profit from operations. Atlas Honda shows a subtotal operating profit. Both are operating profit, but having different names. Assuming that we are not accounting literate. So there is some confusion. One of the subtotal net profit from operations, another one operating profit. For example, we are doctors. And what is this? They are not getting the point. We called our friend, one of the friend in working in the audit firm. What's the difference between net profit from operation and operating profit? He replied, both are same. Both are same. But we asked that particular guy who said that both are same, why they use the different terms? So the person, the PwC having no answer. Okay, that's the point. Concern point. Another point, very important. There are something other income. No? Toyota also mentioned other income. Honda also mentioned other income. But with Honda books, other income is a part of operating profit. But Toyota mentioned other income after the operating profit. You ask your friend, what this happened? Why? Having two different structure. If the operating profit are same, but the operating profit bases are not same. Toyota mentioned the separate line item of other income after the operating profit, but Honda used the other income before the operating profit. This is the concern point. Another important point. Toyota mentioned one separate line item, worker profit participation fund and welfare. But this is not something in the Honda. This is not something in the Honda. One more point. Toyota and Honda both use mention operating expense. Okay, operating expense. Oh, sorry, operating expense. But the other term called other. Other. What is this other? What is this other? What is this other? This is not a joke. What includes others? These are the some concern point. I'm not saying that others should not be allowed. But what are the basis of this? What includes other expenses? Ladies and gentlemen, the problem with IS1, it's too much flexibility. Too much flexibility. Listen carefully. This is the format you people have observed multiple times in your life. This P&L. But IS1 P&L is recommended. IS1 P&L format is not standard. That's the point. It's not a standard. It's recommended. With the recommended format, there is no subtotal called PBIT. That's called operating profit. No subtotal. Some company use operating profit, some company don't use operating profit. This recommendation not mention where subtotal, what includes as operating profit. That's a one point. This recommendation having others, but not mention what are the basis of these others. IFRS 18 also mentioned that you can use the term others, but IFRS 18 mentions some justifications. We will discuss later. Ladies and gentlemen, IS1 having problems. Too much flexibility. Too much flexibility. If you and me are investor and wanted to decide any one, we need to decide to purchase the shares any one of the company, or we need to make any decision making based on the financial statement. So what's your observation? Same business, same sector, automobile, same standard IS1, but look different. Toyota shows net profit from operations. Honda uses the term operating profit. Toyota put other income after operations. Honda puts it before. Toyota adds workers participation fund. Honda does not. So overall, the concern is diversity. Too much diversion. Lack of consistency. It will create confusion to make final decisions. This is the case that we have discussed. Why the need for new presentation? And do you know that ISB, before publishing or before start working or during the working of IFRS 18, has made a survey and get the feedback from investor. That's what the problem you are facing with IS1. The problem we have discussed. Investor concerned, difficult to compare performance across the company. Like the comparison between Toyota and Honda we discussed. Subtotal are inconsistent. Someone uses the operating profit, someone not using the operating profit. I can share you the automobile company where they don't use the operating profit. And some Toyota had Honda using the subtotal operating profit but having different names. Too much use of other category. Is there any basis of others? That's a concern of the investor. Once again, welcome to IFRS 18. IFRS 18 will try to overcome, I mean, IFRS 18 is going to overcome the issues that's mentioned earlier. That's issue related to IS1. Now we are going to start IFRS 18. I hope that you people are with me. We are going to start the discussion about IFRS 18. So what's the big picture change? With my lesson, we will cover the big picture change about the major changes, that's income statement, cash flows, and the notes related to the income statements. Actually, whatever the major change has happened, that's categorized into 4 parts, or we can say it into two parts. Number one, P&L part, which includes 3 changes, or we will cover the change in this manner. That's defined categories, mandatory totals, subtotals, and grouping principles, that aggregation, disaggregations. And number 4, that's about notes called MPMs. So let's start the session. First, we will cover the P&L related matter, that's called big changes. That includes 3 points: categories, mandatory subtotals, grouping. So are you ready? Are you ready? Student, you must be ready, huh? So this is what a suggested presentation of P&L. I strongly suggest you have to pause the video here and read the complete P&L new type of presentation. Pause it. Okay. Now you need to develop your mindset, or your position must be a preparer of financial statement. First of all, make a quick discussion. The P&L, first thing, it's about categorization. There are 5 categorization of this P&L. Operating category, investing category, financing category, income tax category, discontinued operation if available, or if applicable, the IFRS 5. Subtotals. These are 3 mandatory subtotals. Compulsory subtotals. Mandatory. That's become a standard. Every company must use these subtotals. Operating profit is must. Profit before finance and income tax must. Profit last figures must. These are additional subtotals. Additional means not compulsory. Number 1, profit before income tax, you can use or not. Or if IFRS 5 applicable, then you can use profit from continued operations, otherwise not. This is what about the new structure, new shape. You have to focus this point. Ladies and gentlemen, once again, now listen in a different way. Assume that we are going to make the financial statement of Toyota. First of all, Toyota is a car manufacturing company. They manufacture or assemble the car and then sell to the customers. Okay. So if I say that, if I'm going to make the P&L of Toyota, so the first category is operating category. Operating category means whatever the income earned or expense incurred for the sake of operations, core business operations of the Toyota. Core business operations of the Toyota. So that's called operating category. Number one, Toyota sell the car, earned revenue, that's called revenue, IFRS 15. Toyota assemble or manufacturing the car, so all manufacturing or assembling costs, that's cost of sales, operating. Toyota having a department of the selling and distribution, selling expense. R&D department, research and development. General administrative, admin task, okay. Some other expenses like goodwill. But sir, with this format, you also mention others. Yes, others. We will discuss this point later. Others exist, allowed, but with justification. What does this mean? We will discuss later. Here, make sure, first of all, we will start the P&L with the line items, that's called operating category, which means all the income and expenses belongs to core operations of the Toyota. And develop first total called operating profit, and this is mandatory. Then the transactions within the Toyota may be related to investing categories, means Toyota having some spare fund, and the treasury department earned some profit from buy and sell of other company shares, buy and sell of the bonds. This is an example. So gain or losses from other investments, not from core operations, that's called investing category. We make the financial statement for user. User wanted to know how much earning or how much the profit Toyota earns on the core operations, that operating profit. Because that operating profit will continue sustain in future. But other important point is also Toyota earns from investment as well. Other incomes from other investment that's not belongs to core operations. And then the subtotal, mandatory subtotal, that's profit before income and taxes. But Toyota pay or having the cost related to interest. What inside the interest we will discuss later. Very simple, borrowings related interest, lease related interest, pension liability interest, finance category. Then identify profit before income tax, that's not mandatory. But before that, operating profit and profit before financial income tax, that's mandatory. Then income taxes. Then discontinued operation, if IFRS 5 apply. Subtotals, these are 3 subtotals that's mandatory. And these are additional subtotals. Ladies and gentlemen, I hope that you people are with me. Now we need to drill down more about IFRS 18. But the point is that IFRS 18, having a detailed discussion, before the detailed discussion, categorize the business in 2 parts. Categorize. One of the part that is banks and asset management companies. The name entities with specified main business activity. Banks, insurers, all these, investing and financing. Another, other than banks, other than insurance company, like Toyota. More businesses like service business, import and exports, other categories. We will discuss the points with other categories. About the banking and asset, the last part of the lesson, limited part. Our core thing about the discussion is about others. That's not banks, not the insurance company, not the asset management companies. We are discussing manufacturers, retailers like this business, online businesses like all these. Let's drill down the thing with the business case. Toyota. And what we are discussing, the big games about the P&L. P&L, big games having 3 points. Defined categories, mandatory total, subtotals. Number 3, aggregation, disaggregation. But we will discuss aggregation, disaggregation later part of the lesson. First thing is about, the first one is about the discussion, details about defined categories and detail about mandatory subtotals. Now come on. The first one, the extract of the P&L. If we are Toyota, what inside the operating category? That's guided by IFRS 18. What inside the operating category? Very simple, quickly. Rule is very simple. All income and expenses of Toyota from core business operations, even unusual or volatile. Rule number 1, there are 2 rules whenever, for example, if we are making the Toyota financial statement. So what inside the operating category? All the income and expenses from the core business operation. For example, the Toyota core business operations, income and expenses, IFRS 15 revenue, all manufacturing, admin, selling cost. Okay. But is this extra that's include this operating category? Yes. Another one is default rule. Default means there are total 5 categories. Number 1 is operating, rest are others. If any of the transaction that not belongs to others, not about investment category, not about financing category, not about tax category, not about discontinued operation, profit or loss category, that by default fall with operating category. Like, for example, if I say goodwill impairment, think about it. Very excellent, very pleasant weather today. Think about it. Goodwill impairment. Is the goodwill impairment belongs to investment? No. Is something finance? No. Something tax? No. Discontinued operation? No. So by default it belongs to operating category. Goodwill impairment. More examples. Listen carefully. During the year 2023, let's suppose Toyota having some seasonal variation, or for any reason, for 2 months time period, the operating warehouse that was spared, they have decided to rent it out temporarily. Do remember, the warehouse Toyota originally used for business purpose, or I can say that property plant equipment. That warehouse was a part of the property plant equipment, but for temporary purpose, there was no use for temporary purpose. They sublet. Oh, sorry. They rented it out to someone else, other companies, and earned some rental income. So that rental income related to unused warehouse. This is not investment income, because the warehouse use or warehouse for the purpose of business usage. That's a property plant equipment. So its default rule belongs to operating category. But there may be confusion from at your side. Sir, what if about the investment property? Listen carefully. Investment property. When we categorize or classified any property, that's called investment property. For example, if Toyota purchase any warehouse, but for the sake of rental purpose, for the sake of capital gain. So originally, that property, it's not classified as property, plant, equipment. Originally, that was investment property. Any rental income from investment property, it's a part of the investment category. I'm not talking about this. But the rental income from unused warehouse, that's the part of property, plant, equipment, that's a part of the core business operation. That's the point that we have to declare here. That's the point. So what includes operating category? Rule number one, any income expense from the core operations. Number two, default rule. If it does not fit with any four, that belongs to here. Like goodwill impairment, like rental income from unused property, plant equipments. Simple. Main core business operation or beyond. Covers both main business activity and other activities. Unless other activity applies. Very clear. Further, what is the role of operating category? Number one, what is the purpose? Shows the complete picture of Toyota operations. Complete picture of the company's operations. What they add less means income or expenses from company's operations. Investor perspective. Investor rely on operating profit because they wanted to know the performance, what the Toyota has performed in terms of their business core operations. And further, based on that information, they wanted to forecast the future cash flows. Because these are regular cash flows, Ladies and gentlemen, another one, investing category. What income expenses in P&L belongs to investing category? What the rule? Rule. Return from the asset that asset generates separately from the company's business activities. Return from the asset that generates returns separately from Toyota core business activities. For example, if Toyota having investment property to any rental income from an office tower, any rental income that belongs to investing category. Further, if Toyota having investment property and classified as investment property and having a policy to apply cost model, not the fair value model, cost model. The cost model related, if apply cost model, any depreciation of the investment property, that's related to investing category. Depreciation of investment property belongs to investment category. Equity holding. Toyota Treasury Department purchase shares of another company from a stock market. Any dividend from equity shares from another entity that belongs to investment category. Any fair value gain that belongs to P&L category of the equity holding, financial asset fair value P&L. Gain or loss, that's related to investing category. Any investment in joint venture or associate by Toyota, for example, having investment with a company which having a multiple electric vehicle charging stations, and Toyota invest the money here and declared as joint venture or associate according to the relevant standard, and apply the equity accounting. Equity accounting share profit that belongs to investing category. Once again, make clarification with the comparison. If any asset part of the core business activity, property, plant, equipment, class and related expense classified as operating. Property example, property developer rentals, that's operating. Or leave it, Toyota property related income for the time being that we discussed earlier, that's operating. If asset held independently, classify as investment. Investment property, rental. What is this relevance about the investor perspective? Why it's relevant? Because it's distinguished core business profit, the Toyota profit versus investment profit. That's benefit for forecast the sustainable operations versus some external returns. External means Toyota internal sustainable or core business returns are sustainable. We can project for future. But for example, other incomes from, for example, fair value gains for equity and like this, dividend from other equity investments, these are not sustainable. That's not the core part, but the income. Last one, very important. Student, listen carefully. Listen carefully. Last one, finance category. Finance category. Listen this one. A little bit technical. Number one, there are IFRS 18 categorize liabilities in two categories. Very simple. Liabilities into two categories. Number one, pure finance liability. What does this mean? Pure. Bank borrowing, pure finance liability. Issuance of bonds, pure finance liability. Finance liability means a liability through which the company generates the funds. Generate the funds. They generate the cash, debited with bank or cash. That's loan, bonds. Any cost if charged to P&L related to relevant standard says that that's charged to the P&L. About pure finance liability belongs to liability finance category, belongs to finance category. Any cost means, for example, if you issue the bonds and generate the funds, interest, that's a cost. What other cost? Issue the redeemable bonds. So issue the redeemable bonds means you pay the dividend, but according to the relevant accounting standard IAS 32 or IFRS 9, it belongs to it's a liability, and any dividend pay of the redeemable preference shares that you have to charge to the P&L. So that's not interest but dividends. Maybe according to the IFRS 9 or the rules, you issued the loan for the trading purpose and declared as fair value P&L. So any fair value adjustments that belongs to here. Any cost, issue cost of the bonds issuing, that's a part of the effective interest rate. So that means if the liability about the finance, a liability belongs to pure finance based on raising funds, any cost, interest or any cost charged to finance category. But on the other hand, other liability which is a liability but with financing element, but not based on raising finance. For example, unwinding of discount. For example, unwinding of discount. For example, lease liability. Lease liability, the transaction will be right of use asset debit, liability credit, not the bank debit. Unwinding of discount, no cash generation. Pension interest, IAS 19, pension in net interest, not the current service cost. Pension net interest, IAS 19. Contract liability with financing component, IFRS 15. Other liabilities, only the interest cost which charged to finance category. That's for sure. That's for sure. Lease liability, only finance cost charge here. For example, IFRS 16, you are lessee. You just initiated a transaction called lease. And at the point of lease, the transaction is right of use asset debit, for example, 100,000. and lease liability credit 100,000. But same time at same date you paid some registration cost. So bank credit, direct cost, direct registration cost, debit. It's maybe the part of the right of use asset. It's detailed to the IFRS 16 and over the period expense out. Okay, it's a different thing. But that cost, that particular cost, it's not the part of the lease liability. Oh, sorry, it's not the part of the finance cost. It's not finance category. It's about the right of use asset. Right of use asset will depreciate and start to the operating card, operating category. So only interest with this other liabilities, with this umbrella, charged to the finance category. These are some examples. For example, automobile context. If Toyota having bank loan, so interest related to banks. Lease liability, only interest. Pension liability, only interest. Sir, pension liability interest, IS 19. What include IS 19? Number one, current service cost. Current service cost is part of operating category. Why? Current service cost is part of operating category. Why? What's the reason? What's the reason? What is the reason? Because current service cost belongs to the manpower. The manpower. And manpower, any remuneration in terms of salaries, in terms of pension, training costs, it's all about the operating category. It's all about operating category. That's the point. But pension related, even pension, current service costs, past service costs, all these are all these about operating category. But pension related, unwinding of discount, net interest cost, that's belongs to finance category. Then dividend on liability, that's redeemable preference shares, unwinding of discount, we have already covered, fair of value gain, all these matters. Other two, what are others? Oh, sorry, before others. The purpose of finance category shows company's performance before financing and taxes. Shows company performance before finance and taxes. Clearly view of underlying business results. And about the investor perspective, it's very clear. It's helped to analyze operational stand versus the financial burden. Financial burden means how much the finance related cost we have. And make a cross company comparison. Easy to comparable. That's simple point. Rest of the parts very easy. Income tax, all the taxes means all IS 12 current tax, deferred tax belongs to income tax expense, including any foreign exchange differences related to tax, only related to tax. Forex about the tax matter. Rest of the part forex we will discuss later. Discontinued operation, income expenses from operations that are sold or held for sale. If IFRS 5 apply, then the separate line item that's called discontinued operations belongs to here. Otherwise not. So ladies and gentlemen, this is what the P&L shape. And as a maker of the financial statement, we have to notice that whenever we make the financial statement, the background is about that, or the structure is about that. First, we will start with the operating category to find out the total mandatory subtotal of operating profit. Then we will move to the investing category to identify profit before finance and income tax mandatory subtotal. Then we add the finance category. It's a company option to add on this additional subtotal. Otherwise, move towards income tax. Then additional subtotal, it's also optional if IFRS 5 applicable. Profit from continued operations and loss from discontinued operations. And then finally the mandatory subtotal, that's called profit. This is what about the big game. Let's practice. Whatever we have done till now, We have to practice the question, how these things can be examined during the exam. Let's come on. Come on. This is a practice question number one. This is a practice question one. I strongly suggest you have to pause video and read this content. Pause this video, read this content. Pause this video, read this content. Pause this video, read this content. Okay, let's start. Green energy company, a company that operates solar farms, has prepared its draft of P&L for the year end 31st December X5. Draft statement of P&L 31st December X5. That's operating, investing, financing. Sir, do we need to make heading for operating, investing, financing? No. This is not the requirement. Okay, but the operating part, revenue, cost of sales, admin expense, depreciation of solar equipment, unwinding of discount, here, operating profit. Then investing, gain on disposal of investment property, then profit before finance and income tax. After that, financing, interest, expense in bank. What's the question? How the examiner can examine the question? Identify and explain. Identify, explain errors made in extract regarding the categorization and resulting subtotals. Two things here examine, or here the question is about two things. Is something mistake with the categorization, means unwinding of discount, it's wrongly categorized in operating. That should be the part of financing. So if you change the presentation, obviously that will impact on the subtotal as well. So not only to identify and explain the categorizations, but also the effect of subtotals. So you have to aware about that, how to respond answer. If you wanted to respond this answer, so maybe the question that a junior accountant has made that particular matter and all these things. So how will you respond that? Very simple. Listen carefully. The junior accountant made two specific errors that need to be corrected to comply with IFRS 18. Number one, error of categorization. Error about categorization. Unwinding of discount on decommissioning provision has been incorrectly classified in operating category. Under IFRS 18, this item of finance expense, it represents the time value of money, which is a cost of holding long-term liability. Holding long-term liability. Liability means other category of liability, not an expense of core operations. The correct categorization or classification should be finance. Finance. So you need to identify this. Then heading of subtotal error. Direct consequences of misclassification. Consequences on operating profit, because you have to add extra expense in operating profit. I know that overall, there is no change with the overall profit, because you need to aid, withdraw from operating and incorporate with financing. But change with the subtotals, that's important. And this will be important for the user of the financial statement. Okay. By including $8 million finance expense in the operating category, the reported operating profit $122 million, which is incorrect. Correct operating profit should exclude this item. So the correction you need to make. To correct the errors, $8 million unwinding of discount must be reclassified from operating to finance category. And you have to respond the answer like this. Number one, change the categorization. Number two, impact on subtotals. Both you need to mention. Impact on subtotals. Number one, operating profit increase, because eighth expense you will withdraw. That's reflect to 130 million. Means increase the operating profit. 122 plus 8. 122 plus 8. Number two, profit before finance and income tax. Profit before finance and income tax. That's this category. Also increased by 8 million, because obviously 122 it's become 130. Then 130 plus 20. So other subtotal will also affect it. That's become 150. And the final profit remain unchanged as they simply moved between the categories. Move between the categories. Sir, there is also the matter that you mention here, that's profit before income tax. This is not mandatory. This is not mandatory. By the way, this is the point how to answer the question. That's the point. One more question. But before that, this is what about the correct extract. Correct extract. Operating profit 130. Because you added the 8 one. Then investing gain on disposal remains same. That's 150. Finance includes interest and unwinding. That's a one line item. That's one line item. 10 plus 8, 18. That's the extract, not the complete structure. Okay, sir, can we practice more question about that? Yes, why not? Sure. Another question, another. Practice question. Yes, this one. These are the possible questions the examiner can examine. Sir, if the question asks with explanations how to respond that, don't worry about that. And all of the category of the questions includes with my lesson. Number one, read this question carefully, very carefully. This is the question. Only this, extract of the question. Read it. IFRS 18 subtotal and categorization. Draft by junior. Another question. Operating profit is 500,000. And the extract is operating profit, directly profit before tax. No further subtotals. Missing these subtotals. Profit before finance and income tax. That's this subtotal is totally missing. Okay, operating profit 500,000. No details what includes operating profit. What includes? But after that, these are the line items. Gain on sale of surplus land held for investment. Surplus land held for investment. This is not the part of operating profit. Okay, interest income dividend 10,000. Interest on bank loan. Pension service cost IS 19. Service cost component. Past service or current service, all these. But this past service cost, it's not the part of the profit. That should be the part of 500,000. Means before 500,000, pension cost should be adjusted. Okay. What are the issues? Issues. First of all, highlight the issues. Number one, missing subtotal. The very mandatory subtotal profit PBFIT is missing. There is issue about operating profit. Pension service cost is an operating expense, should be within operating, not after that, not below it. Investing, gain on investing, property disposal is investing. Dividend receive is investing. And loan interest is financing. Important point. Corrected presentation, IFRS 18 compliant. recalculate the operating. Very simple. Some expenses, if some expenses missed, you have to adjust it. That's 500,000 minus pension cost expense 460,000. So you have to adjust the first subtotal, that's 460,000 operating profit. Then investing surplus as 50,000, investment income 10,000. So that's 60. 460 minus 660, the subtotal you need to mention, that's equals to 520. 460 plus 60, that's equals to 520. Finance, interest on bank, finance, profit before income tax, that's 520 minus 30, that's equals to 490,000. This is what about IFRS 18 compliant. Sir, if the examiner asks to draft the answer, read it. This is how to draft the answer. Very simple. I'm not going to read it. It's very, whatever we have done above, we have to write it. And I hope that the students, all of my students have already aware and already learned that what is the right method to draft the answer. It's just about the principles or about the case to explain the structure, all these things, all the point. All the point. Read it, no worries. So what we have done till now, the IFRS 18 big picture about change in P&L, the presentation of the P&L. There are three things that need to cover, but first two we have covered, subtotals and categorization, and we have done some practices. Well, huh? Now next point is about aggregation that we will cover after the break. Break time. Let's have a tea. Thank you.